Modern investing often feels like an anxiety trap. You stare at a screen, watching numbers flash red and green, chasing a sense of euphoria when a line ticks up, and feeling a knot in your stomach during every dip. 90% of people view the market this way. They treat it like a casino where you need a genius-level IQ to predict what the price will do next week. Even Warren Buffett, a man whose net worth eventually topped $100 billion, spent his first 8 years investing with this exact flawed approach. Starting at age 11, he was obsessed with reading charting books and technical analysis. He spent hundreds of pages trying to predict short-term stock market behavior. He eventually realized that intelligence is irrelevant in this game if your foundational orientation is based on gambling on price action. At age 19, Buffett read Benjamin Graham's The Intelligent Investor, and it completely rejiggered his mind. He reached a core realization. The secret to investing is to permanently stop buying stocks and to exclusively start buying businesses. He looked past the speculative energy of the market floor and focused instead on the tangible reality of what those companies actually produced. He stopped caring whether a stock price went up or down the next day or the next month. He realized that financial clarity begins the moment you stop trying to predict the market's mood. To master this mindset, Buffett proposes a thought experiment. Imagine that the stock market has been completely erased. Imagine you bought a private asset, like a farm. There is no daily pricing here. You cannot check a ticker to see what your dirt is worth on a Tuesday afternoon. This chart isolates the farm's value from the market. You judge the investment purely by its long-term crop yield, the actual bushels of corn or wheat it produces each year. If a neighbor offered to buy your land for half of what you paid, you wouldn't feel poorer. You'd probably try to buy his land too, because more acreage at a lower price simply means more future crops. When you treat public companies as private farms, market crashes transform from terrifying threats into logical opportunities to own more of a productive business. This logic applies to buying shares of American businesses. You are buying the output of industrial machinery and human labor, not an abstract ticker symbol. Evaluating real-world output removes the emotional distress of market volatility. If the business is productive, the daily quote becomes irrelevant. Buffett followed this rule so strictly that he has kept at least 80% of his net worth anchored in American enterprise at all times. Financial serenity comes from divorcing yourself from the market abstraction and anchoring your savings directly into this real-world productivity. When you look at millions of people working toward that productivity, the scale shifts from a single business to the growth of an entire civilization. To see how much that collective progress is worth, look at John D. Rockefeller. In the early 20th century, he was the richest man. Yet for all his billions, Rockefeller couldn't buy modern medicine. Today, the average citizen has access to better education, faster transportation, and dentistry that doesn't involve the primitive tools seen here. This chart shows global population throughout history. Notice this tiny fraction, less than half of 1%, representing the early American economy. They generated over 20% of the world's total bounty, building a scalable engine of innovation. The true purpose of long-term investing is simply attaching your savings to this consistent historical trajectory of human improvement. We see the massive scale of this system's results everywhere we look today. A person can sit in their home and watch a game with instant replays on a high-definition screen, something that was once pure science fiction. This inherited ease is the byproduct of foundational ingenuity from inventors like Thomas Edison. They did the heavy lifting, and today we use their tools. Because of this compounding efficiency, 1 hour of labor today delivers exponentially more value to a family than it did 100 years ago. Buffett's metric for success is simple. He prioritizes doing what he loves, with the people he deeply trusts, viewing wealth as a partnership tool, rather than collecting random possessions. Shifting your focus away from the flickering screen and toward the long-term value of human ingenuity turns the market into a source of stability. It becomes a patient, optimistic way to share in the future of progress.